Good afternoon and welcome to S&B Consulting's latest webinar. So today we are going to talk about tax governance, and we are also going to look into some very important aspects of corporate tax and transfer pricing. For today's speaker, we are joined by Manish Saraf, who is a partner with our practice. He has over 20 years of experience in tax and risk advisory. He has previously worked with Deloitte and PwC. Prakriti Dangi, who is our tax director and an expert in corporate taxing. She has over 10-12 years of experience and has joined us from PwC. Shraddha, who is again an expert in UAE corporate tax and transfer pricing with over 10 years of experience and previously worked with Deloitte and PwC. About me, I am Manish Bucha. I'm based out of Dubai and have over 20 years of experience in governance. I have previously worked with PwC and KPMG. So collectively across the panel, we have over 65 years of experience. So we are well represented today in terms of tax knowledge. And in terms of the agenda, this is what we are going to go through. Next slide, please. Yeah. So I'm going to talk briefly on the tax governance. And then my team members, Manish Saraf, Prakriti, and Shraddha are going to talk on the key elements of corporate tax in the UAE, the tax return filing, key aspects, compliance on transfer pricing, and other administrative issues related to the corporate tax. So in terms of the webinar, it is recorded. And so for those that are joining now, you can go back to the recording later on and can play back at your leisure. It will also be posted on our LinkedIn, so you can watch that repeatedly if you would like. But in terms of what we are going to cover, I've already spoken previously in terms of the agenda. I'll start with the evolving tax landscape in the UAE. And before I start, in terms of any questions that you might have, you can post them. There is a Q&A box at the top of the meeting invite, and you can post your questions in there. We will try to address some as we go along through the presentation. And then there is a session right at the end of the webinar where we will pick some of the questions that you have asked. So please do put in your questions if you have, and we will try to answer as many as we can. And if we don't cover them today, we will get back to you. So please do leave your name and your contact details so that if any of the questions remain unanswered, we can get back to you. So at first, it is important to understand and appreciate our tax surrounding. And it is also important to understand and realize how UAE has transformed from a virtually zero tax economy in 2017 or pre-2017 to being a consumption-related tax economy where an excise tax and custom tax were introduced and levied on certain specific trades and consumption patterns. We thereafter saw a transaction-based VAT regime was implemented, which now is almost 7 years old, or should I say 7 years new, as it continues to evolve and reshape itself with new business models, new commerce, and new trade-related patterns which the country is experiencing. Then UAE committed to certain international tax principles such as economic substance regulation and country-by-country reporting. To us as tax professionals, this was a robust data gathering and data transparency standards, which the authorities over here used, and it was implemented successfully. And ultimately, we saw the most anticipated corporate tax and transfer pricing regime being implemented in 2023. With various international tax principles imbibed from various parts of the world, and this directly impacts the bottom line of almost all businesses which run within this country. Of course, if we go into the future and into our very near future, we are yet to see how Pillar 2, where global minimum tax would take form and shape within the UAE corporate tax regime. And in due course, we will also see how the federal tax authorities conduct corporate tax and transfer pricing audit. One could also argue that a robust withholding tax regime, or maybe some sort of an advanced tax regime, which we are already seeing in some other Middle East countries or Middle East region may also be part of UAE tax regime. But for now, these are the existing laws for the pie of UAE federal tax. And there are laws which continues to challenge us from a business model perspective, from a tax positioning perspective, and we need to maneuver through these challenges. And whether you are a trader, whether you are a fintech player, whether you are somebody with an industrial license, whether you are a family-owned business, it is fair to assume that most of the provision of these several laws would impact you either operationally on your profits or on the transaction or from a documentation perspective, and hence the need for a well-governed tax infrastructure. A tax-governed framework which can empower you to maneuver through these challenges and ultimately add shareholder value. While a tax levy is charged on your net profits or on your transaction basis, we are really so what we want to discuss are really the key principles of a tax governance framework. And I think if I was to start and give you some example, just like in accounting perspective, we have our accounting policies which are driven from IFRS, or our HR policies which are driven by certain mandates given to the HR team within the organization. There ought to be a clear strategy and tax policy which will help the shareholders understand transparently as to what really are the tax risks a particular business model or structure is exposed to. And in that manner, how does an organization go about adopting technical position on critical tax matters? At what level does a particular tax matter get escalated or a particular tax responsibility gets delegated depending upon the impact of it on the bottom line? What level of shareholder management and communication is maintained within the organization to ensure, for example, if you are a business which is looking for an possible IPO or a business which is looking at a particular strategic fundraise, then what would be the tax impact? This is something that you need to analyze. And that's why a well-documented tax strategy and policy helps. Relevant, sorry, can you go back to the previous slide? Yeah. It is also equally important that there is adequate senior oversight and accountability. There are transactions which has to be conducted, which has to be recorded, and businesses and companies need to ensure that there are adequate oversight and accountability on those transactions. Transparency with stakeholder and communication. When we talk about communication, it is also important that how the communication with the Federal Tax Authority. There are a lot of elements which are still whereby federal tax authorities has already identified avenues as to how they can be raised and for any kind of a clarification. And I'm pretty sure this is going to evolve over time. Compliance with laws and regulations was the most important thing. We need to ensure that whatever transactions are being carried out are in compliance with the applicable laws and regulations. And the team is going to talk more about in terms of what are the compliance requirements as far as corporate tax and transfer pricing are concerned. And in terms of tax planning, we need to ensure that whatever tax planning is being done is within the legal and ethical boundaries. Training and awareness, whether you are a company which has an in-house tax practice or in-house tax team, which is taking care of your tax requirement, how they are trained, how they are ensure that they are aware of the changes which regularly keeps on coming in, or whether you rely on a third-party consultant, tax expert to help you with your tax initiative. Technology and data management are key, paramount important. There's a lot of technological advancement which we see are currently available in the market, which is helping you in recording your financial transactions or your tax transactions, and it will keep on evolving. And how do you continuously review and improve your tax governance? So irrespective of which taxpayer population you belong to, there are three key actions that each of the organization needs to ensure as far as tax governance is concerned. First is to undertake a gap analysis, looking at what you currently do to ensure the tax risks are mitigated and the expectations that has been outlined with your management, with your board is achieved. Address those gaps which has been identified, whether it is in terms of improving your policies, improving your processes, the documentation, introducing new processes of control, and then to regularly keep on testing and ensure that whatever has been implemented remains effective. So that's overall in terms of tax governance. Now I will invite Manish Raf to take it forward.
Yeah, thank you, Manish Bucha, for giving a good insight about the governance. And it is very important for anyone to have a implementation of the tax. That governance has to be put in place in terms of policies, procedure, and the systems. Are they aligned to meet up your requirement of the tax new tax regime? So, getting into this corporate tax, what I'm going to talk about on the different aspects of the tax return, the what are the applicable main key points. So where we are, because we have a time frame, so we'll focus more on the key consideration points. And I mean, as which has mentioned, that please raise your questions on the chat box as we go across those points here, and we will answer it during our session today. And whatever we present our views is our internal views, I mean our own, because anyone who need to apply to their business, they need to refer to a consultant, understand the laws, because tax is more on transaction based. So each business will have a different situation, and that need to be applied considering the laws provision and consultant guidance. So giving overview of the corporate tax, as we see that it is applicable based on the source of income, like it is source based income taxability or a resident based taxability. And when we talk about the resident category, then there are three under which the persons are being taxable. Either it is being established, incorporated in UAE, so LLC companies which are incorporated in mainland or free zone, they are taxable. The foreign entities being managed from UAE, so the decision making of companies set up in UAE, the management sits out of here, and they have a business in Saudi or other regions, and then those, if the decision making is being done here, the board decision making are happening in UAE, then those get taxable. Or a natural person conducting a business like a consulting service or freelancing activities which are business in nature, then those also individually they need to pay tax. It can be, and he may be doing this activity sitting in UAE, for Singapore or any other country. So the income earned from those countries anywhere as an individual will be taxable in UAE. And there are three categories for a natural person which is not taxable. Just to recap, it is about the salary income which you earn, or a real estate income, or an income from investment activities that are not taxable for a natural person. Now, coming to the non-resident, it could be in the form of a permanent establishment, like a branch. So a company in Singapore having a branch in UAE, that is a permanent establishment that will be taxable here in UAE, or earning a UAE source income. They might not have a PE, a branch in UAE. A Singapore company not having a branch in UAE, they are trading in electronics, they're directly supplying it in UAE, and through an agent who's selling it off, then the income which is earned, that it becomes again a taxable. Or having a nexus, that means, which has been recently clarified in the cabinet decision, that a non-resident holding a property in UAE earning an income from them creates a nexus, and that is who's going to be a taxable person in UAE. And looking at this corporate tax return structure, there are 9 sections to this corporate tax return, which has first category starts with the taxable person information about the taxable person details, their legal status, the LLC companies and what kind of structure they have. That details goes in this. Then we have elections, which is very critical, because need to be identified that there are certain elections which are to be done in the first time in the return, and you cannot go and revoke next year. So you need to be very particular about those elections which need to be filled up. Then the accounting schedules, which goes with your accounting statements, need to file or audit report to be submitted depending upon the size and the threshold. Then certain adjustments which has to be done, then the reliefs which has to be opted, and then other adjustments which are deductible, non-deductible. Then when you have any presence outside UAE and you get an income from them, then you have a tax credit, which goes in this part G. And then finally, when you submit a return, you review and give a declaration. Then each section which is being filled up with respect to elections or accounting schedules and all has a schedule linking to it. That is, as a detailed schedule will open up. So if you filled up, like you opt for a qualifying free zone and you opt for it, then there's a detailed schedule which need to be filled up on that. And this return is filed to the Emirate Tax portal, and you generally use a same login, a standard login, to refile the return. So we'll talk about each of the sections bit brief on this. So first is the taxable person information. So make sure that your details are registered properly in terms of if there is any change in the business activities or any kind of informations about the legal status need to be updated. Because what we have seen during this last 6-7 months of filing the return, that the details are not correctly captured, and we need to update those registration details, because what you would have registered as a corporate tax registration when you have submitted it, the details will automatically pop up when you start filing a return. But when you see that details are not correct, then you need to go back and update it. And the authority takes 20 working days to respond. So that planning has to be done well in advance. You might think that, some of them might be filing the return by 30th July because of late penalties waiver, or they have 30th September, depending upon the financial period. Most of those companies in UAE have Jan to December, so 9 months, it's September. So you need to be pre-prepared for that, that details are correctly updated. Then in the taxable person, you also have this unincorporated partnership. This is where the details has to be filled up about it, because as an unincorporated partner, those income what you earn from different business will be taxable in individual hands. So those detail has to be filled up, and it will link to those what you have been reporting in those partnership. Then you have this with respect to the accounting incomes, basis of accounting it is basically if the revenue is less than 3 million, then you follow cash basis accounting. And of course, if it is more than that, you have option. You follow accrual basis accounting, whereas cash up to 3 million, you have option to whether to go for cash basis or accrual basis. So that option need to be filled up. If you have a revenue less than that 3 million, you have an option to select cash basis. And then confirming on the business activity, if you are actually having multiple business activity, make sure that your registration details are correctly updated. And then you will have to take treatment if you have presence in the free zone, whether your activities are meeting those requirements of a qualifying free zone. Benefit need to be looked into it. And then in case you have a presence outside UAE or Singapore, Saudi, anywhere, and or in India, if you are a resident in that country, then you need to take a tax residency certificate, because that need to be uploaded in the return to get a benefit of double tax avoidance agreement. And then in case if someone is opting for a free zone, then that analysis need to be done, and you need to opt and click a tick mark on that you are going to opt for a free zone benefit, qualifying free zone. Then different, as I was mentioning, the schedule will open up. The detail need to be filled up in that. So as I was referring to the elections, and this is very critical to know that, as I was mentioning, that there are certain items which are irrevocable, that is one time opted, you cannot go and change in next year return. So you need to be very careful about those. And these are the three items which are there: realization basis, which is authority doesn't want to tax you for the income which you have not earned or you're not realized. Like, you might have an asset and whose market value has increased from, say, 500,000 to 600,000. So 100,000 gain, which is there, which is just a book gain, is not actually realized. So it will be only realized when you actually sell it off. Then that is a real income you earn it. So authority want to tax you on that. So you have an option whether you want to go for realization basis. That means all the income when you actually dispose of or you actually earn, then get taxed, not at the time of just a book accounting. Then transition rules apply to the cases of the assets which are basically immovable property, intangible, or financial assets. And then again, the gain which is pertaining to the first tax period. That means if most of the companies having the cycle of Jan to December, so 1st January 2024, prior to that, any gain which is there will be deducted, or that one will be excluded from the taxability perspective. So the gain will be only taxable from 1st January 2024, whatever you have earned on those immovable property, intangible, and financial asset. And there is a specific method which we'll talk about in subsequent slide. And foreign establishment, permanent establishment exemption, that means if you have a branch outside UAE in Singapore, so, and if the tax rate is more than 9%, then you have an option whether you want to include those income in UAE or not. So that option is again need to be selected in the first return. And then you have an annual option and then annual elections, basically small business relief, depending upon your threshold of 3 million. Then if any transfers happen within the qualifying group, that is an option where you have more than 75% of investment, and on any capital transfer will be netted off, will not be taxable. And then similarly is the provision related to that business restructuring relief. So let's look at that detail. So realization basis, it is either most of the financials would be prepared. I mean, those are more than 3 million revenue. They will be prepared on accrual basis. When it is being prepared on accrual basis, you have options, on the realization basis as well, whether you want to opt for A option or B. So the option A basically covers about apply to the realization if to all the asset and liabilities subject to fair value or impairment accounting. Now, what are those assets which are subject to fair value? Your investments, your financial assets, so you have invested in any properties, those are generally being considered at fair value. And then only any investment in security market or any other businesses you have invested, that will be at the fair value. And then exchange gain and losses are on the fair value. Or in this scenario, if you opt option A, then any gain which is unrealized in this will not be taxable. Or option B is all the assets and liabilities held on capital account, which are long-term investments or land, buildings, or any kind of held investment in the bonds or goodwills. These are something which are on capital account. So any gain which is unrealized will not be taxable. Now, whether to go for option A or option B depend upon the kind of the business you are. So you need to be very careful about it. So you need to assess your financials. If you are into trading business, you want to see whether, because you are holding a lot of inventories, whether should we go for option A because it covers the inventory. If there is any change in the inventory, any gain which is coming in, you don't want to get taxed immediately. You want to postpone it when you actually sell it off. So those options need to be evaluated when that considering your financials. If someone is service industry, for them the option would be different, or into manufacturing industry. So this option need to be assessed based on the kind of business you are to. Then is the transition rules. This applies, as I was mentioning, for the assets, immovable properties, or the financial assets or the intangible assets. Now, first criteria is that for the immovable property, this should be carried on historical cost basis. That is, as on 1st January 2024, they should be historically recorded. If someone has bought an asset in suppose 1st January 2019, and this has been carried at a historical book value until 1st January 2024, considering the depreciation and all. So that any gain which is arising, on your disposal, maybe you're not disposed in 2024, you're disposing it in 2025. So the gain from 1st January 2024 till, maybe April 2025, what you have arrived is that portion which is taxable. Now, how do we derive that? It depends upon the method you are using it. It could be based on the valuation method, where you need to have a market value as prescribed by the authorities for that immovable property, or it could be based on the time apportion, that is a period of holding for which you are having. So the holding period prior to 1st January 2024 will be excluded. Only the holding period from 1st January 2024 will be considered, and that portion of gain will be taxable. Now, in case of qualifying financial assets and liabilities, which are basically if you have investments and any other businesses, that would be and those are should be how they are qualifying means they should be being in hold prior to 1st January 2024. If you have been holding those assets and liabilities prior to 1st January 2024, then those are the items which are eligible for this transition rules. And in this case, the holding period is considered, only the time apportion method is considered. And for qualifying intangible assets like patents, copyrights, which are there, only the valuation method is applied for them, considering the market value. Now, if you don't make any option of transition rules, okay, then what would happen? If you don't opt for anything, then the entire gain, even prior to 1st January 2024, that get taxable. So you need to be very careful and opt for this transition rules. Then this is a foreign permanent establishment, having establishment like a branch in Singapore, UAE based entity having a branch in Singapore. So they have an option to whether they want to get all their incomes or expenditure to be included in UAE and then apply the foreign tax credit on that, or they have an option to see whether not to include that income and expenditure in UAE. So if they opt of not including those income and expenditure, provided they have this 9% taxable in that other jurisdiction, then they can opt for it. In that scenario, they will not include income or expenditure, and then the tax credit will not be applicable. Only foreign tax credit will be applied when they have included the foreign income and the expenditure and the tax which has been paid in those countries. So often whether to now this option of claiming a foreign PE exemption applies to, like when they have elected that they should meet those criteria, and it applies to all their branches. They could have a presence in Saudi or Singapore or any other country. So all these need to apply the same principle. It would not be that they opt for, Singapore or other entities. So they need to be considering for all. Transfer within the qualifying group. That is, the first criteria is they need to be a parent and a subsidiary relationship, a company A, company B, parent and subsidiary, and C, the subsidiary of A. Then this relationship is hold, then only they're going to get a benefit of this qualifying group. And minimum holding is 75%, whether direct or indirect. So in this scenario, if you see company A is holding 95% in B and then indirectly holds in C, and overall he's holding 75%. So company is holding 70%. In this scenario, if there's a transfer between company A and C of any capital asset or liabilities, then any gain arising from that will not be taxable. Now there is another criteria that if that asset is being transferred, like if the transfer happened in 2024, and if it is getting transferred in back or sold to third party in 2025 or 26 in the next 2 years, then whatever gain or losses what they have considered as not taxable with the option of selecting transfer within qualifying group get taxed in the year when it is getting transferred. So the holding period, if that is transferred within 2 years, then it gets taxable. So that's a clawback which is there. And another is that there should not be more than 50% change in the transfer. So that structure should remain. So the whole purpose of this is a tax neutral, that if this is transfer which is happening within the group will not be taxable. But this is again a part of elections. You need to opt for this. Then the small business relief is election, which basically applicable to the entities having income less than 3 million. And this is a temporary relief which is given, and it is because it will there until 31st December 2026. So it is not a continuous basis. It is only applicable until 31st December 2026. So in this case, what would happen that when you opt for small business relief, which has to be ticked in the return, when you fill up a return, you need to tick on that you're going to opt for this small business relief, but you need to assess whether you want to go for this benefit or not, because in case you go for a small business relief, then you're not able to carry forward any tax losses which are there. So if you opt for the return of 2024 which is being filed in 25, then any losses which are there in 2024, or if you continue to go and opt for the small business relief in 25 return that is filed in 26, then the losses which are there in this year cannot be carried forward. So that need to be assessed. And the good part is that this is an annual assessment. So it is not like one time you opt for in 2000 in first return will not be revocable. So you can assess annually and to see whether you want to benefit or not. And this is not applicable for the qualifying free zone companies and also those which are part of multinational enterprise group, which is holding more than like total revenue of 3.15 billion dirham. Are not being eligible for the small business relief because it is specifically eligible for 3 million limits. And of course, there is no requirement for local file and master file. But the key important part is that the revenue which you are computing has to be as per the IFRS accounting standards. Now, talking about the business restructuring relief, again, this is annual assessment. You can look into it whether you want to opt for this business restructuring relief. And it is basically when you are disposing it of one part of the business. Suppose a company has a leasing business and a facility management business, and they want to dive off their facility management business. And in that case, if they're selling off their facility management business, the gain that has arisen will not be taxable in this business restructuring. Now, one of the criteria for this is that the consideration for this transaction should be in terms of ownership share. So that means they have to, and this exchange of shares happening, which is 50% ownership interest should be still maintained. Like if company A, which has a leasing business and a property facility management, is selling it to company B, then the company B, which is buying this facility management, then company A should get an ownership interest from 50% should be, the transfer consideration should be in the form of ownership stake. And again, if the clawback period is there, if that is being disposed of, suppose company B, which buys this business in 2024 from company A of facility management, is selling it off in next 2 years, then whatever gain which was not taxable in the year when you opt for this will be taxable in the year when the transfer is taking place. So company A gain what they have derived will be taxable in that period. The other part is the corporate tax return is accounting schedules. So now what are submitted as part of the accounting schedule is your income statement, your comprehensive income and the auditor's report. Now auditor's report is applicable only there is a threshold requirement. If it is more than 50 million, then audit report is mandatory. Or if you are going to opt for a qualifying free zone person, then audit report is mandatory because the basis on which you have derived or you opted for this qualifying free zone authority would like to see, and that's the reason they want to have that audit report. And in the form, in the CT return, you need to write the name of the auditor and the opinion being given by the auditor, because that would form the basis for the authorities to pick up the cases for a scrutiny or analysis, based on the different opinion given on that return. And this basically, and in case of a tax group, now if the entities which are having a tax group, they will have a consolidated, they opted for tax group, then a single return is being filed for them, and then any intergroup company transactions which are there will be eliminated. Now there is a requirement effective 1st January 2025 that for the tax group they need to have the audited report submitted. For 2024, that is not mandatory, but from 2025, January 2025, it is mandatory. That means the return which is for 2025 will be filed in 2026. Then they need to submit the consolidated audited financials. And the most important part is that the return has to be submitted in dirham. So your audited financials also has to be in dirham. That you need to make sure that you submit an dirham currency. And then of course, for conversion, you might have some companies have their audited done in dollars, then that need to be converted in dirham, and as prescribed by the FT authorities, the central bank rate has to be used for that conversion. And in case you have qualifying free zone, then better to have a segment might have an income which is non-qualifying income also, and some of them could be qualifying income. So have a segment financial in the financials, have the segment details, which is the income pertaining to your qualifying and which is non-qualifying income. And some of the adjustments and the other exempt income which has to be reported in your the return. is that, if you start with basically profit before tax, and then you are going to split between qualifying in other income, investment under the equity method accounting adjustments which are pertaining to your investment under the equity accounting is that when you're holding more than 25% investment in other businesses, then those are reported under this equity method of accounting. And what happens in this scenario is that you are going to include that income in the P&L, the dividend which is there, and also it is included in your investment also. The investment value increases with that dividend. So in that case, the dividend which is shown in the financials has to be adjusted because it is already included in your investment in the balance sheet. Then incomes which is from the unincorporated partnership. In case of unincorporated partnership, which is treated as a separate taxable person. Now, in case of unincorporated partnership, what is happening is that there's no difference between the owner and the partnership, basically the partners. So the partner is getting taxable. But now, if the partners apply that unincorporated partnership to be treated as separate person, in that case, that the partnership is taxable, not the individual. In that scenario, you need to do the adjustments in your financials and your accounting income. That portion is not taxable, and that need to be adjusted. And income and losses not subsequently reported in the income statement is the scenario where you have items being reported under the other comprehensive income, like there's a change, there's a revaluation gain and losses, which is generally reported below the income statement. So those are not considered when you derive your taxable income. You use the profit before tax, and the other comprehensive income line item is not considered. So that need not be adjusted in the computation of tax liability. So in terms of how we start, as we are mentioning, we start with accounting profit as per the IFRS accounting standard, and then we carry out certain adjustments pertaining to your exempt income, your deductions, deductible, non-deductible, transfers within the group, or unrealized gain or losses based on the option you're going to select in your return, and the taxable income, and then adjustments happens with respect to your tax liability, foreign tax credit or withholding tax credit you would take and derive this. So this is an overview. And these are basically some of the adjustments which happens in your accounting income. There is a provision with respect to interest expenditure, which is limited to 12 million or 30% of EBITDA, which is earning before interest, depreciation, and amortization. So you have a limit of 30% or 12 million, whichever is higher, and it can be carried forward up to 10 years. So if anything is more than this amount, will be carried forward in next 10 tax period. Entertainment expenditure, which is pertaining to your shareholders and customers, will be allowed only 50%, whereas for employees, it is 100% allowed. Charitable donations will be adjusted back. If it is for qualifying public benefit entities, then it is 100% allowed. Expenses incurred to derive an exempt income. Example, you have invested in any company and you earn a dividend from there. So since dividend income is an exempt, so the loan borrowed for investment or the interest paid on that will not be a deductible expenditure. So it needs to be added back. Any dividend profit distributions, of course, is not taxable, is an exempt. So if it is already included in your accounting income, it would have been included. So you need to adjust that. Withdrawals by the natural person is not an expenditure. It is just like a current account withdrawal, so it will not be a deductible. And any penalties or taxes itself is not a deductible expenditure. And also recoverable VAT. That means generally VAT is recoverable from your output. Your input expenditure VAT is recoverable from output. If that is not recovered, then you need to adjust it back. You cannot claim it as a tax deductible expenditure. For example, for telephone bills or your fuel bills, where the amount of VAT is very minimal and we don't claim that from output. In that scenario, you cannot deduct that expenditure. But something which is not deductible, which is not claimable from output VAT for like employee-related expenditures, then that can be an expenditure deductible in your deriving a tax liability. And the transfer pricing adjustments, which my colleague Pragati will take over, explain in detail. Then tax liability and tax credits. Basically, you start with your taxable income. After doing all these adjustments, you derive your taxable income. Then you look into any tax losses. So tax losses can be carried forward unlimited period of time. So if you have any tax losses, suppose you're filing, of course, for first return, you don't have any carry forward tax losses. But if you're filing your second year tax return, the tax losses of the previous period can be adjusted in the subsequent period income. So that will be adjusted against that. And if you have any losses for first return, can be carried forward unlimited period. Then your corporate tax liability will be derived, and after corporate tax liability deriving that, you have a foreign tax credit which is being paid on the income earned in Singapore or any other country. Then that tax credit is allowed. So if you see, this basically all these details are linked to the schedules. So and whatever has been filled up in the schedule will be automatically popped up on the tax liability computation. You just confirm that those details are being correctly being captured. So once you have filled up all the details, then the date of filing has to be captured, and the one who has prepared this return, either individually or by the legal representative, has to be mentioned there. And then the signature has to be done. So there's no digital signature, but yes, it is automatically, if you write your name, that will pop up there. So just to summarize on what are the key considerations to be looked into is your once you open up and file your first tax return, the tax person details, are they coming up accurately or not? If there is any changes, or the legal status has changed, or a structure has changed, or business activities is not updated, make sure that business activities is updated. And it's very important, because what you show as a source of income from different businesses, are they part of the trade license or not? That need to be updated there. Then now financial period, change in the financial period. Now some of the companies might have their financials, the book financials is prepared, suppose April to March, and they got their corporate tax registration for Jan to December. So now, I mean, they need to be very careful. If the corporate tax registration is for Jan to December, whereas you are preparing your financials in April to March, then you need to apply for change in the financial period to the authorities in your corporate tax registration. And there is a 6-month window. I know it has to be applied within 6 months of your first tax period ending. And then, of course, the IMATax portal has to be looked into, the correct details have been captured. In case you have got a penalty for your corporate tax registration, late registration, which is 10,000, and you have just until 31st, I mean, the return has to be filed within 7 months of your first tax period. And the companies which have their closing in December, so they have 31st July 2025 to submit their return and claim the waiver of this penalty which you would have received. So you need to just see that whether you have this any penalty, just make sure that you are filing your return within 7 months of your first tax period, whereas the normal period is 9 months from your tax closing of the financial period. You need to assess whether you are eligible for qualifying free zone. You need to, before preparing your return, you need to do a corporate tax impact assessment, to see what are the benefits in terms of elections to be done, or small business relief to be taken, or opting for a qualifying free zone person benefit or not, because those assessment is very much important, and accordingly you can opt for different sections which is there in the return. So do a assessment what you are eligible for, and then submit a return. And then in case you have if there is a revision required in what you have filled up and submitted, okay, but the revision can be done until the final due date, which is 9 months. If you have submitted a return in April and your due date is still 30th September 2025, you can still make the changes in that. In case you have submitted the return, what happens and due date has expired? So there is again a voluntary disclosure provision which is similar to a VAT. So if it is if it is more than 10,000, then you need to go and do a voluntary disclosure and correct that in the next return, next financials. If it is below that, you do not do a voluntary disclosure. It can be updated in the next return. So that's basically overall from the corporate tax return. Now I would invite Shraddha, who is going to talk about the administrative penalties and then some of the transfer pricing compliance requirement. So Shraddha, over to you. So should I stop sharing and you will share your screen?
Yeah, I'll share my screen.
Thank you.
So I hope my screen is visible.
Yes, I think it is just popping up.
Yeah. Thank you, Manish Butta, for the introduction, and thank you, Manish Saraf, for taking us through the corporate tax compliance requirements. So I'll just quickly take all of you through the penalties in case of late registration. As Manish already mentioned, there is a penalty of 10,000 dirhams. And if we want to waive off that, we'll have to file the return by 31st July for the companies with 31st December 2024 as year end. Also, one more important point here is that we just have to file the return by July. However, we can still pay the taxes by 30th September. So we still have 2 months time to pay the taxes. So the taxes are not required to be paid by July. We just need to file the return. Coming to the late deregistration. So deregistration is required in case of cessation of any company. So if any company is liquidated or it doesn't exist, we'll have to deregister the company, and we have 3 months from the date of the company which it ceased to be existing. And any late deregistration, there is a 1,000 dirham fine for per month, and maximum it can be 10,000. In case of any late filing of corporate tax return, it is a 500 penalty per month for first 12 months and then 1,000 per month thereafter. And in case of any incorrect return, which is not corrected before the due date, which is 30th September, it is 500 dirham. Next, coming to the late payment and the disclosures. So any late payment of corporate tax. So the point which I was mentioning is that we can pay the taxes by 30th September. So in case of any late payment, there is a 14% tax interest which will be calculated monthly. And if we make any voluntary disclosure before the audit, it is 1% of unpaid tax. And if any voluntary disclosure is made after we receive the notice from the FTA, it is 15% fixed plus 1% of unpaid tax per month. Coming to the penalty on the record keeping and documentation. So we need to maintain the documents and keep all the records, especially for the entities which are qualifying for the free zone. So in case of any documentation, especially for the transfer pricing, any documents which are required for the valuations, if they are not maintained, there is a penalty up to 10,000 and a repeated penalty of 20,000 dirham within 24 months. And failure to provide these documents in Arabic language on request from the FTA is a 5,000 dirham penalty. Now coming to the updating information, so failure to notify FTA of any updates for tax related information ensures a 1,000 dirham penalty and a 5,000 if repeated within 2 years, and a legal representative not notified to FTA penalty of 1,000 dirham. Audit and miscellaneous failure to cooperate with the FTA during the audit is a 20,000 penalty, and late submission of required declarations like transfer pricing forms, local file, master files, etc. is 500 per month and 1,000 per month after first year. So I'll move to the next section of this webinar, which is transfer pricing. And I'll talk very briefly introducing transfer pricing. So transfer pricing basically applies to intercompany transactions where the companies are related in any manner. So as per the FTA, we have three basic criteria for determining if two entities are related parties or not. The first one is the ownership, the second is the kinship, and the third is the control. There are four additional criteria also, which are like a foreign PE is there, or a trustee, which is a holding a share in the foundation. Then also they become the related parties. But we'll discuss in detail the primary criteria. So the first one is ownership. So in case any individual entity or it together with its another entity are having a joint ownership of more than 50% in any other entity, they become related parties by virtue of ownership. By virtue of kinship, two parties become related parties up to the fourth degree of kinship. So a person and his or her spouse and their relatives up to the fourth level of kinship in their family, if they are having any entity and they are holding ownership, or by virtue of control they are related parties, they become a related party to each other also. The third criteria is about the control, which is not very specified and a bit vague, because control is not something which is very clearly defined in the law, but we have to analyze it on a case specific basis. So it is different for every client. uh, we have tried to precisely mention the broad criteria which can define control. So either the entity is having 50% or more of the voting rights, or they determine the composition of the board of directors the 50% or more, or they are earning 50% or more profits from the other entity. And the last one, as I mentioned, is a very case specific, like we have to analyze from client to client, which is that the one of the entities having its influence on the other entity. By influence, we can mean either the influence in their day-to-day business decisions, or the strategic decisions, their products pricing, uh, numerous things, whatever business affairs they are having. The next article 36 defines the connected person with reference to the transfer pricing. So this transaction, I would say, is very important, especially because in many other jurisdictions this is out of compliance because they have personal income tax already over there. But in UAE, since we are already having only corporate tax and we are not having personal income tax yet, so it is important that companies are not shifting their profits to the shareholders or the owners, the individual per se. So by connected person, we mean any individual who is owning or having a significant ownership in the entity, or the directors or the officers of the entity, or the taxable person like the CFO, CEO, etc. But this is also, as I say, this is a very case specific, because in a very big group there are various divisions, and there are maybe 13 to 14 CFOs of every division. So it's not like every one of them will become a connected person. But yes, definitely we'll have to see in the bigger picture how many of them are actually influencing the business decisions, and they are the key influential person or not. The partners in an unincorporated partnership also are the connected persons, and any of the related parties to the above individuals also fall in the parlance of connected person. So now, once we have, determined that the person is a connected person, we'll have to maintain the documentation for the benefits and salaries which they are receiving from the entity. So this has to be in line with the transfer pricing arm's length, and they have to be benchmarked properly, so that we can justify that if any third party would have been in place of this connected person, he would have also received the same benefit and the salary payments. One more important point is that many companies are having their personal expenses also that which are being presented in the financials. We can only allow the payments which are incurred only for the business purpose, and any such personal payments which are made has to be excluded. They are disallowed. I'll move to the case studies so that we can, clearly see what is transfer pricing and how they are affecting the companies, and you can better consider for your company as well. So first one is mostly about the ownership. So here we have four companies in the picture, where company A is directly holding company B and has 100% of shareholding. So directly company A and B are related parties. Without batting an eyelid, we can say that. Now company A and B also are related party to C, because both of them are jointly holding 90% in C. So company A, B, and C are related parties. But now when we are coming to determination of related party relationship between A and D, we need to calculate the percentage of holding. And when I did calculate that, it's coming to 72%, so which is greater than 50%. So in this scenario, A and D are also becoming related parties. However, had it been maybe a shareholding of 40% over here, and it would have come to less than 50%, A and D would not have fallen in the relationship of related parties, and then we would have to only analyze the transactions between A, B, and C. So this is another case study where company A is a manufacturing company established in UAE, and it decides to outsource its suppose admin service or HR services to a company B in India, maybe due to gain advantage on location savings, and it is remunerating that company based on cost plus model for whatever back office support services it is receiving. So, very briefly, cost plus model is that suppose company B is incurring 100 rupees cost, it will maybe remunerated based on 100 plus 10%, and it will receive 110 from company A. However, what is happening is in this scenario is that there is a bank in India and the company B receives a loan from this bank, which is being financially guaranteed by company A. So now in a third party scenario, any company would not have provided financial guarantee to any other company, and especially without influencing the terms and conditions. So company A, maybe with its credit worthiness or other terms and conditions, it is influencing the terms of these loans also. So company A, by virtue of control, is becoming a related party to company B, even though they are not having any common ownership or kinship. So this is where case specific we can present that, you know, in this scenario, even though when company A and B are not related by ownership or kinship, they are becoming related parties. So we'll have to see how control is being established in other clients, and we'll have to analyze that particular scenario. Now, in this picture, if this financial guarantee is being provided by company A, guarantee fee now needs to be provided by company B to A for provision of such guarantee, and that has to be determined from an arm's length perspective. Coming to another case study. So now here company A, which is in UAE, and it has wholly owned subsidiaries in India and Singapore, which is company B and C. So like many other MNCs, here also the procurement services are being centralized at company A. So centralized services are like services which are being, you know, provided by one of the entities to the entire group, so that we have we are cost efficient, and we have an advantage on the cost savings. So company B is seeking for procurement services from company A, for which it has to liaise with a third party company in India. So this contract is signed between the company A and the leasing company in India. But the payments for the rental payments are also made by company A to the leasing company. However, when company B will cross charge to A for the procurement services, it should only pay a markup on the procurement service per se, and it should not pay for the markup on the leasing rental payments. So by rental payments, I mean any such pass-through costs which are being incurred by company A in provision of procurement service should not be paid with a markup. They should be paid without a markup. They should be reimbursed on cost to cost basis. So in case of IT services, these can be example of any software license. So suppose if I am a company which is providing IT services to all my group entities, and I'm purchasing a software, so I'll only charge markup on the cost of service which I'm providing. I should not charge a markup on the purchase price of software per se. Maybe I'll invite Prakriti now to discuss transfer pricing documentation in detail and take us through that. Thank you.
Good afternoon, everyone. I hope my screen is visible to one and all so that I can begin the session.
Yeah, it is.
Yes.
Thank you so much. So thank you so much for joining us. I'm Prakriti Dangi. I'm Director and S&B Consulting, and I deal with corporate tax and transfer pricing advisory and compliances for the UAE businesses. So in terms of the content of the session, just a thing, I think my camera is not on. Give me a moment. That's better. So in terms of the content or the agenda for today's session on transfer pricing documentation, we will be dealing about when and what and required for transfer pricing compliance and documentation. So we are all hearing about the local file and the master file and the disclosure form, but there are so many questions around it. And today we are going to unfold all these questions so that it facilitates one and all on the right compliances. So when we talk about transfer pricing itself is a new term to this jurisdiction. And pricing, as we all know, it's about how do you price your transactions. But the only specific case here is that if you are having a related party transaction, the related party definition, which we have taken, which Shraddha has taken us through in the previous slides. So if there are transactions or arrangements with related parties or connected persons, in that case, the pricing needs to be gone through the transfer pricing mechanism. Now, there are guidance from the OECD, which is the Organization for Economic Cooperation and Development, which is a global organization. Then again, there are guidance from the UAE FTA as well on what is the requirement, what is the compliances required to be made in the transfer pricing. Again, guidance is given with a lot of examples. Now, the another term that we talk about in transfer pricing is arm's length of transaction. So when we say arm's length, we mean that all the transactions with the related party or the connected person are to be done on a basis as if it were done in a similar situation with a third party. So where you have any transaction which you have done with related party, and if you are able to compare with a third party within your organization, that's a good comparable, which is called internal comparability. And then in case internal comparability is not possible or feasible, then you can always take leverage of external database, which are the globally accepted public database available, on which a structured search and economic analysis can be taken up for arriving at the arm's length price. Now, even arm's length price is not specific that it is a transaction by transaction basis pricing for each of the invoices. It could be, or you can also test the margins of the business or pertaining to the transaction that you're having with the related party. So it's very subjective and it's not directly available from the read of your financial statements. It requires a lot of discussions, functional interviews, deliberation to come up with what is the best analysis for transfer pricing for the specific transaction and for your business. Now, when we talk about a transaction, it also expands through the arrangement. So even if you don't have a book entry for a transaction, but there is an arrangement, maybe it is a free of cost transaction, even there, the transfer pricing is applicable. Now, for connected persons, the law mentions that the expenses will be deductible for your taxable income computation only when it is at arm's length. We have taken up few examples at later stage of this presentation. The other point is, for all the other transactions with the related party, each and every transaction needs to meet the arm's length standard. So although there are thresholds for maintaining the disclosure, for documentation, local file, master file, we know all these jargons and the terms flowing around. However, for every penny of transaction with the related party or connected persons, arm's length principle is equally applicable. So let's look at the practical scenarios. There's a company called New Trade LLC, which is claiming a small business relief in its return for financial year 2024. So the question arises that in the return, if you click on election for small business relief, you're not required to go ahead to answer the questions on the related party relationships and the amount of transactions that you have entered. So does that mean TP does not apply? So to answer this, the guidance very clearly provides that the TP still applies. However, a documentation is not required to be prepared. But in specific cases where there is a related party transaction, you may require to prepare a TP documentation, not required to be benchmarked or submitted in the as a part of the disclosure requirement for the local file and master file requirement are not applicable in that case. There is another entity which is high cost with no related parties. That's a standalone entity in the UAE. Now the question comes that whether TP will be applicable. So of course, the TP principle applies to each and every entity in the UAE. However, if there are no related party transaction, the documentation requirement may not be required. There is another company which is incorporated in the UAE. However, its branch is in overseas, say Oman. So that branch becomes a permanent establishment in the Oman for the BAF LLC company in the UAE. In that case, the transactions with the PE are again under the net of related party relationship, and transfer pricing as well as documentation equally applies to the company. This is a scenario where there is an unincorporated partnership. Mr. A and Mr. B are the partners. So what happens to the transactions that are entered between the two partners of the company or of the unincorporated partnership? Again, as a result of their being partner in the UI partnership, the TP is equally applicable. Documentation is required. There are other examples. For example, what happens to the deductibility if the payment to the connected person is beyond the arm's length price? So say in a company, there is a person who is a connected person that has been identified. The compensation to that person is 82 million in the current year, in the tax period that we are talking about. They come up with benchmarking and arm's length analysis, and they arrive at a decision that the arm's length pricing is 1.5 million. Now, what happens to the excessive 0.5 million dirhams in the calculation for tax liability? Certainly, the law is very clear on it. The excessive will get disallowed, not to be deductible for calculations for tax liability. Again, a documentation to substantiate how you have arrived at the arm's length basis is very much required in this case. Again, for claiming QFZP relief, out of the conditions mentioned in Article 18 of the Federal Decree Law 47, as well as the ministerial decision of 265, it clearly mentions that to gain the benefit of 0% tax rate for election in QFZP, you're required to maintain a TP documentation and determine all the transactions with related party at arm's length. Now, what this arm's length principle is, how do you arrive at price? There are many companies in the UAE who still question this phenomenon or this terminology. So I am going to take you through the steps by which you can have an arm's length analysis in your hand for your related party transactions in the company. The first and the foremost point to start with is identification of the related parties and transactions with the related parties. Many times clients to us for our financial reporting purpose, the auditors are putting only these kind of 1 to 3 related party transactions as a disclosure in the financials. So related party is restricted to that. However, I beg to say that you need to go and delve upon what is the scope of transfer pricing that we have seen in the previous slides and exactly match our related party in transactions with that to say that whether it is applicable or not. So the thought does not stop at the related party disclosure in the financials, but it goes beyond that and takes you to Article 30. Thank you. The next is to do a functional analysis. So it's about understanding the functions, which is the activities that the transacting parties are undertaking. Understanding the assets with the help of which those transactions are undertaken. And also understanding the risks which each of the parties bear to perform those activities. That functional analysis is done through a lot of interviews, through the operations, to the finance accounts department in each of the functions or operations of the company or the business. In case of large multinational organizations, multiple rounds, and to each of the respective departments, an interview is required for that. Now, once it's done, a characterization is arrived at, and that takes us through the economic analysis. So once you know which party needs to be tested out of the two transacting entities, you start performing the benchmarking analysis on the tested party. So ideally, tested party as defined in the OECD and also brought in by the UAE TP regulations is entity which is the pricing or the margins of which is required to be tested by, and how it is a tested party is by virtue of the uh, complexity of their operations in the whole value chain, as well as the availability of data for comparability. Now, once it's done, there are 5 different methods available in the transfer pricing guidance. The another one is other method, which could be a combination of one or multiple of the 5 transfer pricing methods. So by this structure, the step is to select one of the transfer pricing method. Again, important part is that once you're selecting one, you need to ensure that the reason for not selecting the others should equally be mentioned in the documentation. Post that, you can conduct a search on a database. There are databases which I've mentioned here, which is TP Catalyst, S&P Capital IQ. These are the globally acceptable transfer pricing benchmarking database, which captures the data of the financial data and the business data of the companies across the globe. You still have the option to select the jurisdiction on which you want to perform your comparability analysis. And once it's done, you can go ahead and look at undertake a qualitative analysis to see whether this company is comparable to my company or not. All of this is a very structured format of search that happens. Now, there is a data limitation in this jurisdiction. So again, the guidance has provided very clearly that you should start with the domestic comparability. However, if that is not available or is insufficient, then of course you can go to regional or global databases or the global regions to conduct the benchmark. Now, all these search parameters and the qualitative analysis and the quantitative analysis is required to be documented. And all this documentation is what we called as arm's length analysis. So it's a comprehensive report which is there, and the FTA may ask for this documentation even if the thresholds of preparing a TP disclosure, local file, master file is not available. So if you see this slide, TP documentation has been discussed in Article 55 of the Federal Decree Law. What it says that your TP documentation should demonstrate the application of the arm's length principle. It should be a very clear, a comprehensive understanding of the transaction and the transfer pricing policies vis-a-vis the transaction undertaken. And it should be able to test the pricing of the transaction relevant to the tax period. Then it tells you what are the documentation requirements in this jurisdiction. So there is one called transfer pricing disclosure form. So initially in the law, it was mentioned as a TP disclosure form, but eventually while the corporate tax return guide was released, we came to know that there is all the details are only required to be filled in the corporate tax return itself. Again, it's important to note that the corporate tax return is a self-assessment of your income and expenses and the related party relationships and transactions, etc. It's not required to be certified or attested by any other person or an auditor, etc. So all the transactions with related party schedule, if exceeds the threshold that we will be taking up later in this thing, will be forming part of the RP schedule in the tax return. Similarly, payment to connected person will be taken care in the CP schedule. So all this is in the corporate tax return itself. The next is local file, which is basically a comprehensive study of the transaction of the company, which is a UAE-based company, and how to demonstrate the arm's length compliances vis-a-vis the pricing and the transaction is all forming part of the local file. Then there is this master file. As the name suggests, it's a master file. It's a comprehensive understanding of the business of the multinational group and its operation. And it also talks about the policy for each of the transaction that has been undertaken in the group. It's more of a global documentation. So if you're required to prepare and file a master file in this jurisdiction, in that case, you should definitely see that if your multinational entity in another jurisdiction has prepared a master file, your master file should definitely be aligning to those master files, because it's a global documentation for a multinational group. All the 1 to 3 items are threshold-based documentation. We will talk about the thresholds later. But the fourth item, which is the arm's length documentation, support documentation, talks about that each and every transactions which you have entered with the related party and connected persons definitely should be documented well. So regardless of any of the threshold, all the transactions need to be substantiated at arm's length. There could be multiple ways, as I mentioned here, to substantiate the same, but it needs to be documented. Now, again, these documents, apart from the TP disclosure form, all these does not go as a part of your corporate tax return. However, the law says that you need to prepare and maintain these things. And if the FTA asks for it, you need to submit that within 30 days of when the FTA asks. So the term contemporaneous becomes so important here, that if you are having you are filing the tax return for 2024 and you are now getting ready, it's equally important that all these documentation arm's length analysis needs to be done now, so that it's not you don't delay the arm's length analysis to a later point in time. Now, when we talk about disclosure, let me take you through this chart, which helps understand whether the applicability is to your taxable person or not. So if there are related party transactions in the company with its related parties, then you have to check the limit of 40 million. And now this 40 million has to be checked on a gross basis. So if you have transaction of provision of services and receive of goods, then if you say though net off karke, I have only 20 million dirham, the transaction of 20 million dirham. However, the law very clearly says that transaction has to be seen on a gross level basis. So provision of services and receipts of goods, for example, needs to be taken separately. And if that amount for the transaction during the year crosses 40 million dirhams, then you have to go and check for the next threshold. The next threshold talks about category-wise transaction. The category is again mentioned in the corporate tax return guide, which is about purchase, sales, services, loans, assets, liabilities. In each of the categories, and again on gross basis, if the total transaction crosses the limit of 84 million, in that case, you're required to fill up the schedule for related parties. In all the other scenarios where either the related party transaction does not exist, or the aggregate transaction value of all your related party transaction does not exceed 40 million during the year, in both the situations, there is no requirement for the business to prepare transfer pricing disclosure, which is forming part of the corporate tax return. Now, since it's part of the corporate tax return, the disclosure has to be goes again within 9 months from the end of FY. A few questions to take you through, and again on a very quick basis. So the first question is to check the applicability of disclosures for RPs and connected persons and local file master file. A quick check. So see, in the first question, the aggregate value of transaction is exceeding 40 million. The category-wise transaction in each of the categories is exceeding 5 million in terms of one of the transactions is sales. And so in that case, both the limits are exceeding, and hence RP disclosures is required. In the next thing, the connected person payments is exceeding 500,000 dirhams. And in that case, again, a connected person disclosure is required. The standalone revenue is 200 million, which is exceeding the limit. And we are required to file the local file and master file here. Very specific cases, which I will take you through, where the specific disclosure or local file master file is not required is say in case number 2, where the payment to connected person is not exceeding 500,000 during the year, and this limit has to be checked per connected person and not total for all the connected person in the business. If that does not exceed the limit prescribed, you're not required to disclose anything in your tax return itself. Then a case where the aggregate of transaction is not exceeding 40 million. However, if you see that in one of the categories, the transaction is exceeding 6 million, in this specific case, the first check has to be aggregated transaction, which is not 40 million, and hence no transfer related party disclosures is required in this case. There is again a scenario where you may be required to disclose all the related party transactions in your corporate tax return, but the total revenue of the company itself is below 200 million. In that case, the local file and master file are not applicable. Now, we should also look on a few case study for applicability of master file. So in this case, the overall revenue, consolidated revenue of the business was 3 million dirhams. And in each of the entities, the standalone revenue was 150 million and 250 million. So in that case, the compliance requirement for each of the entities we would be discussing. Since it's below 200 million, the local file master file, so local file will not be required. We again have to go back and check whether the group is an M&E group to see applicability for master file. We also again need to go and check the applicability for standalone threshold, which if exceeds 200 million, the local file will be applicable. This is again a very big multinational groups where the consolidated turnover of the group is 4 billion dirhams. And for each of the entities, there is specific standalone revenue that they are earning during the year. The 3 companies are in UAE, the other is in Bahrain. So since the consolidated group revenue is exceeding 3.15 billion dirhams during the financial year that we are talking about, in that case, and since the group is a multinational group, in that case, the requirement for master file arises. And in other cases, local file is applicable when the revenue for standalone entities is more than 200 million. However, since the overall, so the law very specifically says that either or. So if the standalone revenue of the taxable person exceeds 200 million dirhams, or the consolidated group revenue of the multinational group exceeding AED 3.15 billion, if either of the 2 cases are met, then local file and master file both are required. So even where XY company, CD company, the overall revenue of standalone entities is below 200 million, they are still required to prepare and perform local file and master file. Okay. I think the slides have been a little crisscross, but anyways. So we've already taken up the case studies, but we can again discuss that a local file and a master file are required to be filed either or are. You have to check the standalone revenue if it is crossing 200 million, or if the multinational group's consolidated revenue is 3.5 billion or not. And if either of the cases is met, both the local file and master file are required. This is again not required to be submitted with the corporate tax return, but needs to be prepared and maintained on a contemporaneous basis by the taxable person to be submitted within 30 days upon request of the FTA. There are a few exceptions for the master file. So when there are groups which are UAE-based groups, which are many here, and they don't have a presence outside the UAE, in that case, the master file is not required. The other is where neither of the threshold is met. So neither the consolidated group revenue threshold is met, or neither the standalone revenue for a taxable person is met. Then in that case, the master file and local file are not required to be prepared. So if we want to understand what is a local file, so these are the contents that are again provided in the transfer pricing guidance document. It's broken down into three major heads, which is you mention about the local entity itself. What is the organization structure? What is the shareholding structure? What are the team employed in the company? What kind of structure it is? What is the strategy that you follow? What are your competitors? So this is telling more about the business and the ecosystem and the industry in which it pertains to. And then it talks about what are your control transactions, and control transactions are more or less same vis-a-vis the related party transaction. So you discuss all about the related party and the connected persons transaction. You give the nature of the transaction, a description of it. You also talk about what is the current pricing mechanism for those transactions. Then you also capture the benchmarking analysis basis which you have determined the arm's length of the transaction. Now, in case there are more than one transaction in a taxable person, it might be true to say that there could be different parameters for evaluating each of the control transactions. So it's not that there is only one benchmark or a one analysis for all the transactions. However, the best approach is to have a transaction by transaction analysis. Of course, at times when details of each of the transaction is not available, in that case, an aggregation approach, which is very much provided in the OECD guidance as well, can be adopted to analyze the arm's length of the transaction. Now, it's important to maintain intra-group agreements. So it's about, which talks about the mechanism or the arrangement in which the related party transactions need to be carried out. Then we have discussed about the functional analysis, which is the function asset risk, the selection of the tested party, selection of the most appropriate method, the benchmarking for each of the related party transaction based on the approach followed, is all which is required to be provided in the control transactions. And in the last, the transactions which are being tested. So the taxable person, which is maybe ABC LLC, the annual financial accounts of that entity, again, what is the margins or the pricing of the tested party, again needs to be mentioned. If required, a segmental accounting account, which is maybe bifurcating the business into different divisions, or maybe comparing the transactions with related party vis-a-vis third parties, can be done. When you do the segmentation, it's important that the allocation mechanism are having a rational and having a logical reasoning, again, which are well documented. So it's a very common tendency to allocate all the costs in the ratio of the revenue. And we say that the margins are fitting into the place. It's all arm's length. However, it might not be the very correct analysis for your transaction, because if you have the revenue at the top and all the costs are allocated in the same revenue, certainly you're going to get the same margins for each of your segments. So it's important to look at each of the transactions individually and see each of the costs and see which is the parameter best fitted to allocate the cost. A few parameters which are again talked about in OECD is the amount of time spent in case of employee cost, or maybe the per square foot rate of rent, or maybe certain direct cost or the utilization of time. There could be many parameters, which is again factual and subjective to the cost that we are talking about and the segment that we are allocating the cost to. So very briefly, if I have to put a local file in for a transaction, there is a company called Aman Lubricants. It is into distribution of lubricants. So it purchases its traded goods from its parent company in the UK, which is again the headquarters for the group. So what will your local file report will talk about? It will talk about the overview of the entity per se. What business is it into? If it is into distribution, you mention that. What are the products traded? Whether any value addition done or it's a plain simple distribution. What is the mechanism by which you make the distribution? Maybe through redistributors or through channel partners, or maybe through retail store, as the case may be. What is the team size? What kind of people are working? How it is managed, whether in UAE or otherwise. What are the controlled transaction. So in this case, to make it very simple, I've taken just one transaction, which is purchase of traded lubricants. You mentioned the amount of transaction during the 2024. Then comes the functional analysis. For example, for function in a typical distribution, it will be importation, warehousing of goods, again distributing, marketing and sales. There could be more, there could be less, definitely depending on how the business is run. Then it talks about what is the asset. For example, distribution network is an asset for a distribution company. The inventory, the risks that is carried, the trademark or the brand right that probably the UK headquarter might have, but you are utilizing it and you are paying maybe a franchisee fee or a royalty fees for that brand rights. Then there are risks associated. So inventory is the biggest factor in a distribution, and maybe in certain products and categories and industries, inventory obsolescence becomes a major factor to affect the pricing of the product. So that becomes important to analyze. The other risk factors could be the foreign exchange risk, the credit risks, the manpower risks, etc. And the FAR analysis need not to be done only for the entity in UAE. But if the transacting entity, maybe it is in UAE or maybe it is outside the UAE, it is required to be documented for each of the entity. That will help to understand which becomes the tested party for the transaction per se. The next is analysis on the economics of the transaction, which takes care of arriving, using of the databases, selecting the most appropriate method, reason for not selecting the other methods prescribed, and arriving at the arm's length margin. There could be interquartile range, which is 25th to 75th percentile, which can be used in case of an external benchmark. Maybe it is carried on TP Catalyst database. You provide a detail of what kind of database that you are using to determine the arm's length margins. Then, of course, as we discussed, the financial data of the company, the audited profit and loss account, if applicable, the balance sheet of the company, and the calculation of the operating margin. There are certain plus and minus or the adjustments that one needs to make before arriving at the operating margin calculations, which again is the tested party's margin, which is compared to the comparable. So those calculations, maybe the segmentation becomes important. And of course, it's really important and critical to maintain all the intercompany agreements. So even if you don't have a intra-group or intercompany agreement in hand now, but it's always important to keep or maintain going forward and documenting all the details of the transactions and arrangement. Go through all the clauses where you protect your rights as per your characterization of the entity. Then we will take you through the master file. So this is applicable only to the entities which are which have existence in outside the UAE. So if there is only UAE-based group, there is no related party or in the group, whether or not you have transactions with them. In that case, only master file will be applicable. So the major heads is talking about the organization structure, list of the related parties, also the flow chart of the structure, business overview, which talks about the profit drivers, the supply chain, the top products, which are mentioned as all the products which are more than 5% of the overall revenue of the group. Then you talk about the intercompany service arrangements, which are specifically not R&D transactions. Then what are the geographical market that the multinational group covers? So all of it talks about the multinational group per se, and not just specific to the UAE business or the standalone entity. Then it also talks about all the major related party transactions and the functional analysis across it. It also requires to mention about the business restructuring, acquisitions, and divestitures, which has taken place during the year or may have an impact in the business in FY 2024 with respect to the master file applicable for this year. Then it talks about the intangibles. Intangibles might be a royalty or a trademark or a know-how, which is recognized in the books of the multinational group. So all the details around it. What are the intangibles that the business recognizes? What are the cost contribution arrangements? What is the spent on the R&D, whether R&D is going to result into an intangible or not? So it's more from an intangible perspective. Then details of the financial activities. There are common central financing arrangements for providing the funding within the groups. Then a whole TP policy around how a multinational groups takes care of the financing function for funding the business within the multinational group. And lastly, annual consolidated financial statements are required to be attached with the master file, and also a brief about the advance pricing agreement if it has been existing for any of the jurisdictions, or maybe any tax ruling which are there with relation to the multinational group. So it's a very high level document, and a consultation and an input from the advisor is very must to prepare and document in a holistic manner so as to comply with the FTA regulations. So this was it from a transfer pricing documentation perspective for today. And I will ask Manish Saraf to take us through the corporate tax return about the key takeaways. So Manish, I will keep sharing the screen.
Yeah. Thank you, Prakati, for taking over us through the transfer pricing documentation requirement, and thank you, Shraddha, for elaborating on the connected and related party, because that is primarily important to understand what are those transactions are, and how we document depend upon the thresholds, limit requirement, what are the disclosure requirement in the corporate tax return. So if you look at the summary, what we talked about today is documentation is primarily important, and the key document for preparing your corporate tax return is your financial statement, because that is the basis on which you're going to look at your what is your accounting income, and then the adjustment which need to be carried out. And this document need to be submitted, and along with the return, the financial statement signed by the business owners as per the trade license need to be signed and stamped and submitted. So, but in case of a small business relief, the financial statement need not be submitted. You need to have a market valuation document in case you're going to opt for transition rules. And if you have a presence outside UAE where you're going to claim for the tax credit, as a double taxation avoidance agreement, then need to have a tax residency certificate and evidence of any tax paid outside UAE. And with respect to other records, your expenditures, your revenues will need to be well supported. And with respect to your qualifying free zone, you need to have those substance documentation proved, and the related party, as Pradhan Prakati mentioned about, the agreement, intercompany agreements which need to be done, the arm's length benchmarking need to be carried out, so very well supported with what the business is carried out in economic analysis. The another retention requirement is that we need to have this documentation maintained for next 7 years. So first tax period, which is ending, suppose on Jan to December 2024. So the next 7 period is 2031. Until 2031, you need to have these records, and it can be in the form of physical or digital record. And primary, it's good to have those records in the system so that you can retain those records. And in case of non-compliances on the documentation, it is 10,000 plus. In case if you repeat that, there is a 24,000 penalties going forward. And overall, if you look at, we need to see whether you have your audit requirement depending upon the threshold, if it is more than 50 million, or if you have a presence claiming a benefit of qualifying free zone, then you need to get an audit requirement. Or in case you are taking a tax grouping, in that case of tax grouping, for the consolidated financials need to be audited effective this January 2025 onwards. Need to assess from the qualifying free zone benefits whether you are eligible, you are meeting the substance requirement or not. In case of elections to be made, there are certain elections which are one time and certain are annual based. So you need to see whether you what are the requirements and do you get a benefit of this. Helps in your planning in terms of your tax return planning. that whether you should go for particular elections or not. Then any presence you have outside UAE, then any foreign taxes which you have, need to see whether you are eligible. Do you have a sufficient documentation for claiming that tax credit? Look around deductible, non-deductible expenditure which you need to adjust in your accounting income to derive your tax liability. The documentation related to related parties, the benchmarking studies to be documented for your arm's length documentation, and then any kind of supporting documents which might be required to substantiate your tax return, and also sufficient document to be maintained, for your carry forward of losses, which once you file the return, the losses which is there will be automatically carried forward, next return, and it can be set off from the future period. So overall, that's basically, from our side. And now we open the floor for question answers. And I can see some questions being put up on the chat box, and I can take off it. So the first question which I see is regarding the due date for filing the corporate tax return without penalty. It is 9 months from the end of the financial period. Most of the companies having Jan to December, or someone having from, say, July to June, then 9 months is March. So whatever depend upon the financial period ending, it is 9 months thereafter. And in case of a dormant entity, do they require to submit their accounting schedules or financial statement required? See, there is no specific tick box in the corporate tax return for dormant entity. It is like, you can claim for small business relief because you don't have a transaction. Then you need not submit a financial statement, but still you need to fill up the accounting schedules, need to be filled up, though it could be nil, but still those has to be filled up in that. Then I can see without penalty, similarly for the tax period. Yeah, in case of a qualifying free zone entity whose audited financial statement is 1st June 2024 to 31st May 2025, but the corporate tax registration shows taxable calendar is, so under the city registration, you have 1st January 2024 to 31st December 2024. In that case, you need to apply for, amending your financial period and for the corporate tax registration purpose. I mean, you need to go and apply and amend that financial tax period in the city registration. So they will amend their MOA and update the city registration details for the tax period, and accordingly you'll align with what you are preparing in the financials. And there's a certain timeline, it is 6 months from the end of the financial period. If you don't do it, then there would be a penalty, and you will need to change it later after the penalty. So now what about the share of profit? I think Mr. Bucha has already answered that. If in case of a profit from an associate, it is treated as a dividend, and then the dividend is not taxable. So with respect to, again, penalties, okay. Now, I think Pragati, maybe there's something, or Shraddha, if you're there, what is the ratio of transaction up to which we can say that it is not related parties transaction?
I think we have discussed that for disclosure purpose in the corporate tax return, the aggregated transaction should be 40 million dirhams during the tax period that we are talking about. And for compliance for local file, master file, there are separate thresholds that we have spoken about. If there is any follow-up questions, we can take it offline as well.
No, I think it is also not only with respect to the disclosure requirement. I think they would also mean that, I mean, maybe which Shraddha was talking about the related parties. What is the definition of related parties, or what are those
I
connected
guess
parties? Yeah.
seeing this question, I think they're asking about maybe the ratio of intercompany transactions to the all of the transactions of the company. So actually, there is no such particular ratio, Sejal. So we'll have to analyze each and every intercompany transaction on a specific basis. So there is no such ratio of to the intercompany to the all transactions of a company. So
Yeah.
even if you have one transaction with the intercompany, we'll have to analyze that, even if it is a 2% of overall revenue.
All right.
Yeah.
Okay. The other question is with respect to small business relief, where there is a requirement of transfer pricing documentation. In case of small business relief, if there is a requirement of transfer pricing documentation, Shraddha maybe, or Pragati, yeah, you can
Sure. So in the case of small business relief, we have covered in the session, but the return does not require to disclose any of the related party transactions when one is claiming the small business relief. However, if there are any transactions with the related party, it's important to keep the documentation around how it is at arm's length, despite you're not meeting the threshold for local file, master file, or the disclosure is required. I hope this answers.
Yeah. Exemptions of the local and master file requirement. I think, maybe because you already talked about, that part of it. One of the key questions which is coming in about the benchmarking of salaries to connected parties.
Yeah, what about,
Yes.
that's a very broad question. What about salary benchmarking? So there could be various approaches, and it's again very subjective. So there could be an aggregation approach. There could be leveraging on the headhunters report. It could be various ratios basis which you could analyze. It could be so many aspects. Transfer pricing is again very subjective. So if there is any specific question, we can certainly take it on offline basis.
The other question is regarding the loan outstanding for more than 40 million from a related party at an opening balance of 2024. Do we have to disclose the same in the TP or disclosure of the return?
So see, loans are generally not transactions. Again, loans which are performing part of the opening balances are, of course, not transaction. But when you say when you go to the category-wise transaction that is specified in the guide, one of the transaction is loan. So if you have to be more conservative, it's important to take or factor that loan again for your aggregation of transaction. And of course, despite you're including or not, for any amount which is outstanding for unreasonable amount of time with for vis-a-vis the related party, in that case an arm's length need to be determined in that. So an interest charge need to be done in that.
Yeah. And the other question is whether this, the threshold of related party, does it include VAT or without VAT? It is actually not inclusive of VAT because, the VAT is a tax amount. So it doesn't include, it is the pure transaction value should be considered for the threshold.
Absolutely.
The other question is regarding the salaries are taken by a partner up to 90% of the consulting fees, and it's opting for small business relief, then how is to be shown, and as no disclosure is required. So this is, as Prakati was mentioning about, the TP disclosure. So there is no disclosure requirement in case of a small business relief, but still it's better to maintain the documentation because tomorrow if your threshold exceeds 3 million, then you need to actually prove that documentation even before the small business relief was applicable to you. So it's better to maintain the document, but disclosure is not required in the return because, it's not taxable.
If I can just add to what Manish,
Yes.
irrespective of what percentage of the total business is taken by the partners as salary, does not matter. It can be 50%, 60%. What is important is that you have the document which proves that the transaction is at arm's length.
Yeah, true. Maintaining an adequate substance in UAE, can you explain? This all depend upon the kind of the business you are into. There is no specific definition, but you need to substantially prove that to carry out that particular business activity, do you have adequate asset? Do you have adequate manpower, adequate expenditure being incurred? So it varies business to business, and each business has to be assessed according to the kind of operations they are carrying out. 0% corporate tax for all free zone or only dedicated free zone. So
All requires a detailed discussion, I believe,
exactly,
to
yes.
say or prove whether it is eligible for a qualifying free zone or not. It's a topic in itself. But if there are any specific queries, you can reach out to us.
Yeah.
It's the rule for managers. There's no rule.
True. Depend upon all kind of activities you're carrying out, and there are different businesses which have different requirements.
So actually, managers will not fall generally under the connected person definition, but yeah, we can see if they are influencing the business decision or something.
Yeah. The next question is about the accommodation car children. So if it is part of the salary and compensation of the connected person, then of course it is a payment to the connected person. So that again need to be arm's length along with the salary that we are talking about.
Yeah. And then other is with respect to the category of taxpayer that must submit the audited financial statement. As we mentioned, there is a threshold which is above 50 million. If your revenue threshold is more than 50 million, then you need to submit an audited financial, or you're opting for qualifying free zone benefit, then you need to submit your audited financial statement, or you have a tax grouping done, the consolidated financials, which is effective from January 2025, which will be filed in 26 for those return. The subsequent return would be required to have a audited financials for the consolidated group companies.
So there is an interesting question whether the kinship has to be seen from a perspective of the which part of the spouse, husband or the wife. So I think it's vis-a-vis the person that we are talking about and not vis-a-vis the male or the female counterpart. Yeah, this has been answered. What is the treatment of VAT on transfer pricing adjustment? So VAT is not forming part of the value of transaction with the related parties. If two UAE parties are related party by virtue of being related party or of connected person, then also TP shall applies. Yes, if it has influence over the business, there could be one director who is maybe owner in one business, director in another business. He is able to influence the business. Of course, it is a connected person, needs to be analyzed in detail, of course.
Yeah. I think there's the last question, which is regarding the intercompany loan balances of 40 million. As on 1st January 2024, during the year, there is no other intercompany transaction. Again, I think you talked about the opening balance of loans outstanding as on 1st January 2024. And if there is no transaction during the year, do we consider in the threshold?
No other intercompany with this documentation.
I think
So,
Prakriti
yeah.
already addressed this one. So
Yeah,
if you have an opening balance and then there are certain time period, so 90 days I think was mentioned, beyond which the FTA will consider it as loan, and then you'll have to apply the interest. And once you apply the interest, then the transfer pricing, you need to ensure that it is at arm's length and you have the proper TP documentation for it.
Okay, great. I think so yeah, I think that's basically all we have now, and I think we have our contact details. You can reach it out, and we can drop your if you would have registered for this webinar, we have your contacts, and we will reach you out, or you can contact us for any further query on this session.